Thank you everyone for joining. We will start in 2 minutes. Hello and welcome everyone. Thank you for joining us today for this webinar, Interest Rate, Market Development and Hedging. To introduce myself, I am Muad Al-Husseini from Ihata Financial. And today we are delighted to walk you through a financial risk management journey around interest rate, market development and the hedging aspects. This webinar is being recorded. We aim to wrap up the presentation within 1 hour, including the Q&A session. However, if there are any questions that remains, we might take a couple of minutes more just to address as much as we can from these questions. We will make sure to share the recording with you post the webinar. During the presentation, you may type any question in the question box on your screen, and we will be glad to answer them at the end. We will also ask 2 poll questions during the webinar, which you can easily respond to by clicking the most relevant answer from the multiple choices presented to you. So thank you again for joining, and we will kick off this webinar. We will start by introducing Ihata Financial, a very brief introduction. Then we will move to a market backdrop to explain exactly what happened recently from a market risk perspective and addressing some of the key concerns that the market participants and the investors have been asking for the last couple of months. Then we will be moving to our core and an important aspect of this webinar, where we talk about how to approach interest rate risk, how to look at your objectives, and then we will briefly touch on the hedging instruments that we see, the recommended or the plain vanilla hedging instrument, and we will provide a brief on that, and then maybe we talk a little bit about the complex transactions as well, and some few elements of how to deal with them on that space. Then we will conclude by tackling an important topic, hedge accounting, which is how to deal with the financial derivatives and apply the accounting standard. And my colleague who is with us here today, Abdullah Al-Ali, will brief us on that section. So Ihata Financial, we are a Saudi-based firm regulated by the Capital Market Authority. we are very much specialized in the financial risk management and hedging derivatives from an independent perspective. So it is very important to note that Ihata is not a product seller, nor it has any advantages or disadvantages from the products that the clients are dealing with the financial institutions. So we remain as objective and as independent as possible. We have started this initiative, and we have worked on multiple mandates here in Saudi Arabia, including publicly listed firms, private firms, government, semi-government entities within the financial risk management. When we talk about the kind of services that we provide, it's within the asset classes of interest rate, foreign exchange, and commodity hedging. We also do all the ecosystem around these derivatives and around the market risk and financial risk, such as valuations, hedge accounting, even dispute resolution as an independent party that look at your trade and advise on the best possible action around them. And of course, this goes when it comes to also restructuring some of the complex transaction, but we really start from the beginning when it comes to the policy setting, how to look at risk, how to identify my objective, and so on. So we will kick off now by walking through a market backdrop and what has happened recently. But perhaps, ladies and gentlemen, it is better to start that with a poll questions that it will appear now. So you can simply answer this poll question when it appears. I will launch it. I think now it's in front of you. Do you have any loans that are exposed to floating interest rate movements? Yes, and we have the hedge in place, or yes, but no hedging in place, or we don't have the floating interest rate movement. Hence, we don't have any loans, or our loans are fixed. You can take your time. In 20 seconds, I will close the poll, then everyone can see also the answers. Okay, I will end the poll now. Okay, so everyone, as everyone can see, there are 2/3 from the respondents who actually have the loan exposure. More than 1/3 of them, yes, they do have the exposure and they have a hedging in place, partially or fully. The third said, yes, we do have the exposure, but no hedging in place. And the latest third said, no, we don't have a loan. This is very typical when we see that around 2/3 are having actually those floating loans. Of course, who answered no, they might have actually investments on the asset side that are exposed also to interest rate. Then this will of course add to the percentage. Thank you very much for sharing your answers. Now we can carry on our presentation. Here we provide a local economic update. I think it's worth mentioning that we will not be spending so much time on the market as much as on our core aspect afterward. However, it is really vital to get a sense of what's happening locally and internationally in the US in specific, given the relationship and given the economic and given the PIG. So what we can see here, maybe the most intriguing chart I can see is on the lower left corner, where we see the CPI basket changes for Saudi. We have started the year in January 2022 at 1.2%, then it has increased, now it's at 2.3%. This is the hot topic. This is the concern that is being asked, and it's being looked at here in the local economy and in the global economy. And there are a lot of questions that are going concerning that. How far can we go with the inflation and with all the oil prices that are currently hovering between 113, 115, 116, as we can see here. Now, the kingdom, given that the kingdom produces oil, this goes into an advantage to the economy. However, we remain very much tied to the policies, to the monetary policy of the U.S. in terms of how our interest rate would move. So that will of course impact. The IMF has expected that the growth in GDP in Saudi Arabia, one of the highest in 2022. So we are not concerned about a GDP growth. Maybe the concern is more around the inflation and more around the possible recession that can actually strike globally with all the interest rate hikes that are happening. And if we want to zoom the picture into a US, we have seen the prices last March has arrived at around 8.5%, and this was very much concerning and the highest from given the period of 40 years. However, maybe it is a silver lining when we see that the inflation in April was 8.3%, still very much elevated or very much on the high side. However, that momentum has broken that we have seen recently. The Fed, everyone knows that the Fed is extremely cautious and very vocal around fighting this inflation wherever it takes. And reading the minutes of the latest May meeting, the minutes have been published yesterday. It was clear that the Fed want to raise a couple of 50 basis point hikes in the coming few meetings, and at the end of the year we will revise and they will review the inflation numbers and they will decide accordingly. The only stopper in this case will be how the economy would react, and perhaps at that juncture the priorities might change. But what we can see in this era, where, for example, the job market has lost around 20 million jobs in April 20, as you can see, and all this number almost have been recovered during the following months. The acceleration in this kind of economic era can happen extremely quickly. So the company should be very much vigilant not to associate itself with what the market would expect, because the Fed themselves, they were expecting 0 hikes for 2022 and 2023, and that was only around a year ago. Then with inflation numbers, the whole picture changes. Following on my latest note, we can see here from 2018 till 2022, in this 4 years, we can see 4 themes that we have observed. So progressing till December 2018, we saw that Fed was very much hawkish, even in their tone, even in their meeting. Then the economy slowed down. Then the dovishness has started from beginning 19 till the pandemic came in. And when the pandemic came in, the economy was almost fragile, or almost, it's very difficult for it to handle any shock. But an unprecedented shock happened, which is COVID-19, and we have seen what happened during the pandemic. And we have seen here the prices of 3-month SAIBOR, prices of 3-month LIBOR are all on the low side. Then the global recovery happens. Then when the Russia-Ukraine conflict begins, the recent Fed hikes started. Then we can see how the prices are increasing dramatically. So if I want to add a theme, I would add also a 5th theme here. And this kind of economic acceleration development was not seen before in such a short time period. When we see locally here, you can see a similar picture of 3-month SIBOR. So our interest rate here locally, we can see where 3-month SIBOR, the expectation of the forward rate of 3-month SIBOR 2 years back, 1 year back, and today. So on 31st of December 2020, the end of the pandemic year, the 3-month SIBOR expectation was almost around 1.2% for June 2022 as a forward rate, as a market expectation. And you can see that the dashed line, how the market expected the SIBOR to be. And the picture has not changed much when we go 1 year forward. So 31st of December 2021, which is only less than 6 months ago. And this is where the expectation of 3-month SIBOR. Now, what happened on 24th of May, the picture is completely different. Now SIBOR is close to 3%, and it's expected, when we look at the forward rate, to hover around 4% in 18 months from now, and it will stay flat. So this has resulted in a 3-month SIBOR rate that is way higher than the market. So in 1 year only, the movement was around 9 basis points only 9 basis points. Then we can see that the surge is by more than 187 basis points when you compare that to what happened year to date. This chart is one of the interesting charts that many clients focus on. They want to understand the opportunity cost. Now, if 3-month SIBOR, for example, now at 2.8%, okay, and the hedging rate at 3.6%, okay, this is an 80 basis points. So the client asks, is it worth it for me to take a negative carry or a cost of carry of 8 basis points? This is healthy. These questions are healthy to understand the opportunity cost, to understand where the market situation is. In fact, the latest spread between the 3-month SIBOR, as you can see, and the 5-year swap hedging for 5 year is around 77 basis points, which is in line with the 5-year average. We have seen the spread reaching 197 basis points and as low as minus 60 basis points. And not until recently you saw everything, and you saw the spread here. So it's important to understand this kind of spread, but it should not direct your hedging decision. Okay, now we are done with the market update. We will be moving to how to approach interest rate risk and how to apply the best practices from financial risk management perspective. And perhaps I would give some example as we progress through these couple of slides. So number one thing that we do in any risk management process is to identify the risk. Do we have the risk? There should be a very clear mandate for the executive management, for the risk owners in the organization to identify this kind of risk. And this risk should be discussed with the executive management, with the board. Once this is identified, we have to move to step 2, which is quantifying and estimating the risk. How much is the risk? How much are we facing in terms of market risk movement in the interest rate, for example, or in FX? Okay. Step 3, we determine the effect of the risk. If you, for example, as a company want to protect a profitability, if you want to protect a certain items on your balance sheet, so we should understand how much this kind of risk that we quantified in step 2 will impact the step 3, my KPI or my objective. Then we move to step number 4, how to manage the risk. What are the best and possible and optimal tools to use to manage those risks? And I'm not here referring to only a derivative transaction. We will see that risk can be managed on balance sheet, it can be managed off balance sheet, and so on. And of course, intuitively, step 5 will be managing or monitoring and assess the performance. All these steps should be really governed by an elegant, clear, straightforward policies in place, being a hedging policy for interest rate, for FX, for everything. And these policies, and this is really important, should be implementable, should be understood by all the parties, should have a very clear governance framework around the responsibilities. Otherwise, it will just be put on the shelf, and when the market fluctuates, everyone will ask about it, and everyone will fail to implement this kind of policy. So it's very important to have this kind of healthy discussion internally to arrive to that policy. When we move to the identification, we can understand that the interest rate risk is any possibility of loss resulting from a change in interest rate, whether you are a borrower or even if you have an investment. So if interest rate movement will have a positive or negative effect, then you have that risk in your organization, and the management of it means that managing the P&L impact that will happen when interest rate moves. So it says a lot about organizing your, for example, debt profile, managing the maturity of the debt. What is the currency? Is it matching with my exposure? What is the fixed floating mix that I have? For example, if I have a 1 billion of exposure, do I have 500 million or 400 million of fixed exposure? So my fixed floating ratio is 40%. Shall I go lower? Shall I go higher? All these kind of questions are very much important. Why? Because it really cultivates a culture of identifying objectives, and this objective is translated into the KPI that we will select in the firm. So that KPI should be very much relevant and has a direct impact on the organization. It has a certain materiality that is not acceptable. That materiality is not acceptable, i.e., that kind of item that we are worried about. For example, that item is a fixed floating ratio. For example, a company might decide that I cannot, for example, have a floating ratio of more than 80 or 90%. I should have a fixed ratio of X percentage. Or for example, a materiality, it's a profitability number. So my IRR in that project should not go below X percentage. And when I did my analysis, the impact on the interest rate, there is a certain percentage or probability that my IRR will be indeed impacted if I don't hedge X percentage. So is it material or not? And that KPI should be very much easy to calculate. For example, an ICR, interest cover ratio, these kind of data can be accessed easily without any disruption or delay. So choosing a KPI, but also keep in mind the simplicity of how these KPIs will be managed, will be monitored, will be reported and calculated. Okay, now when we look at the interest rate management of the exposure, we talked only a few minutes ago around hedging on balance sheet or hedging off balance sheet. We have prioritized on balance sheet here, as everyone can see. Some companies opt to take fixed interest rate at inception. They simply ask the financial institution or the bank to offer only a fixed rate, nothing other than that. So you will indeed be fixing your exposure, and no matter how interest rate fluctuates in the coming 3, 4, 5 years or whatever the duration is, you will be fixed at that rate. Of course, this has many pros and many cons as well. The advantages and disadvantages. One of the main disadvantages is the lack of flexibility. So if you wanted to, for example, prepay the loan, and the interest rate in the market have actually moved lower, then of course there will be penalty charges. So it is very much rigid and inflexible. We can talk about an asset and liability management approach, which is matching the exposure in assets and liability to naturally offset or lower the net exposure. For example, if we have here on this picture, if we have here, for example, a debt, and that debt is, for example, 1 billion, and we have a corresponding, for example, assets, investment that are yielding 3-month SIBOR. So you take the net of that. The same concept or the same logic here applies to the floating debt that can be offset by the cash on the bank. So if you have a debt and you have an interest-bearing cash in the bank, so you don't have to hedge the gross debt amount. What you can simply do is tackle and achieve the hedging by considering only the net exposure and not the gross exposure. Then we move to the off-balance sheet. It's very much popular, and most corporate interest rate hedging is done via linear and non-linear payout derivative instruments. For example, interest rate swaps, interest rate cap. These instruments are also considered pure hedging instrument because it's plain vanilla. When we say plain vanilla, it's very simple, it's easy to understand, and not very much hard to price and to monitor and to also apply the hedge accounting standard that we will talk about at the end of this presentation. So this ends this section, and perhaps we will touch on the hedging instrument and what are the instruments that are here locally, and what we actually recommend for any company that are in the process of hedging its exposure. In a plain language, considering any complex transaction is extremely dangerous for the companies who wanted to genuinely hedge their exposure and focus only on a very clear payout. And this explains why here we are focusing on the interest rate swaps. It's very common: interest rate cap, interest rate collar, and interest rate swaption. And let us take, ladies and gentlemen, here the interest rate swap and cap, and we can explain them in an easy way. So an interest rate swap is a contractual agreement between two parties, you as a borrower and the bank, and you agree on to exchange a certain interest rate payment. And just to avoid any confusion or complexity, let's say that a company has taken a loan from Bank A. That loan is linked to 3-month SIBOR, and there is a risk if 3-month SIBOR goes higher that the company would be paying higher interest rate. So it is not very much necessary for the company to take the hedge or the hedging instrument from the same bank that has offered the financing. Of course, that bank has a priority to actually take it and a right to match if there is a hedging to be taken in place. However, the company has flexibility to take this instrument elsewhere. It is separate transaction. So as we can see here, you are as a company in the middle. If we assume that you are a borrower, and from day one, there are no swap. There are only the borrowing agreement. So only on this yellow highlighted box. So you pay your loan margin, for example, 1% on the loan that you have taken, and of course the floating SIBOR. So if you assume that you are paying 3-month SIBOR, for example, that 3-month SIBOR will reset every 3 months. So if you want to really hedge this SIBOR, you can enter into a swap where you pay a fixed rate depending on the market. As we can see here, the fixed rate for a 5-year swap is around 3.6% currently. So you pay 3.6 on the swap, and you pay on the loan your 1%. So you end up paying only 4.6%. If it's 3.6 plus 1, this is 4.6%. So SIBOR here will be paid. This SIBOR will cancel this SIBOR. So no matter where the SIBOR goes, you will be protected. Of course, as you intuitively gathered from this, there will be a liability if, in fact, the interest rate environment moved lower. You will, of course, say that there is an opportunity cost, that if I did not hedge, I would have participated in the market, and there is a credit line required. But on the good side, there will not be any upfront cost on your hedge, and of course, the hedge accounting can be applied to entire MTM. See, the movement on the hedging instrument itself will impact the P&L. So because the swap is a plain vanilla instrument, and the accounting standard IFRS 9 can be applied if all the critical terms are met, then you can apply hedge accounting, and of course you will exchange a floating interest rate for a fixed rate, and you will have a huge visibility on the future interest rate payment. This is a swap. A cap is a bit different. There are a slight difference here, where the borrower will enjoy the market if it goes lower. The borrower will not pay any fixed rate unless the interest rate environment goes above the cap rate, or we call it the strike rate. The strike is a maximum cost of finance for the borrower. So if we agree that 4% is the cap, then you will enjoy the market as long as 3-month SAIBOR is below 4%. And the minute the accident happens, i.e. interest rate moves above 4%, then you will be compensated. Why am I saying accident? Because you need to pay a premium to get this cap and obtain this flexibility. It is very much similar to insuring your car against damages. So again, if you see here the disadvantages and advantages, you will see that you have this flexibility. However, you have to pay the premium for that. Now we have only a couple of slides around the suitability of these instrument. In this particular section, I have only 2 slides to discuss here, and I might not go into very much detail, but it's very, very important to consider the type of hedging instrument that you want to consider, no matter what are the temptation to consider other complex instrument. As we said earlier, it's very much important to consider on your objective and what you want to achieve. Some companies, for example, financing companies, they lend at fixed rate, long duration, 10-15 years, and they borrow on short-term floating, and if they wanted to hedge, they hedge short-term. So they have a mismatch in asset and liability, and an impact also on the economic value of equity on EVE. This is a completely different KPI from different borrowers. So these kind of discussions should be taken before any interest rate events happen in the market. These kind of expectations should be cultivated within the environment, discussed, challenged to arrive a certain conclusion on how, where, how much to hedge. So as we said, when considering and hedging your portfolio, so we always prefer to look at the plain vanilla instrument as a mean to hedge. It's very basic, very understandable, and most importantly, it serves the hedging objective. So the reason that we made sure to bring this subject is because of what we have observed locally during the last few years. We really witnessed that few firms or entities were engaged into some complex interest rate and also FX derivative transactions, mainly with financial institutions, but there was not clear idea of the potential implication of carrying such risk. So we have no issues if the risks are clear, the objective are agreed, the company is an investment company that they want to speculate. It is okay if there are clear objectives. But when we talk about financial risk management, the picture is totally different, because we have seen some firms could utilize derivative with the aim of achieving short-term gains and supporting operational or financial hurdles. and some others were focused on actually hedging its exposure. But the misunderstanding of the embedded risk has caused them a great deal of financial difficulties due to misalignment between the hedging needs and the implemented strategy. Hence, and again, the issue starts when firms divert from a hedging objective of protecting their core business to the speculative space, which utilizes leverage, long-dated exposure with open-ended risk and limited upside. And most notably is the mismatch, as we said, between the hedging instrument and the item that the firm would like to hedge, be it a loan, FX, commodity exposure. So depending on the eventuality and the magnitude of the outcome, some firms with such practice might run into severe financial difficulty or reputational damage and potentially go into a very difficult situation. So it's very much important to consider how this product or structure will make me take my financial risk management aspirations. Here, maybe because we have a limited time, we will not go into a detail. Here we have put only a small example of something that some clients or some product that are being looked locally, a complex one called interest rate range accrual swap, and they come into an ocean of alternative, an ocean of variations. So we always say, let us focus on the plain vanilla one and look at our house inside. What does it need? What are our KPIs and objectives? So this concludes this section, and I believe next we will tackle the hedge accounting, and our colleague here, Abdullah Ali, will take us through this section. And I believe Abdullah, also there is a pull question that we will start before tackling this topic.
Yes, indeed. Thanks, Maad, and thanks for everyone who joined us today. The last topic that we're discussing today is the hedge accounting, and we will explain where it does fit within our risk management process. Before we jump into the accounting section, let's just put out the pull question to understand where our participants stand. So as we can see, the pull question on the screen, do we have interest derivatives in place now? Yes, and we are applying hedge accounting. The second answer is yes, but we are not applying hedge accounting. The third is that no, but we are looking to hedge our exposure. And the last is no, we do not have interest derivatives outstanding. We'll give some time for the participants to answer. Okay, so we can see that the majority of the participants does have interest rate derivatives outstanding, and they are applying hedge accounting. It's also interesting to see that those who does have interest rate derivatives outstanding, but are not yet applying hedge accounting at the minimum, 7% of the participants only. 21% answered that no, but we're looking to hedge our exposure, and the remaining 25% said no, we are not having interest rate derivatives outstanding. Okay, so we can start with the hedge accounting section. So the first slide that we have in the section on this topic is what is hedge accounting? To answer what hedge accounting is, let's go back to the management process, the risk management process. So part of the process, as you recall, there are 5 steps in the process. First, you need to identify the risk, quantify and estimate the risk, determine the effects of that risk on your internal objectives. And once all of this is done, you'll get to managing the risk. And this is where you need to consider hedge accounting. So let's say that, like in a corporate, you are exposed to a financial risk exposure, that is being currency risk, interest rate risk, or commodity risk. And you have quantified your risk and estimated the impact on your internal KPIs, and you found that the materiality of that risk is alarming, and you decided to hedge it through off-balance sheet approaches. So Then you apply the hedging strategy to manage, let's say that you have a loan exposed to cyber. To reduce the variability on that cash flow linked to your loan, the interest charges, you enter into interest rate swap, and then that is a hedging strategy. What you would be facing in that case is an accounting mismatch. So the financial derivatives will be treated accounting-wise as fair value through P&L. So the value of that derivative will be spared in your P&L, and any variability in that value would be hitting your P&L. Whereas your underlying hedged item, the interest charges on your loan, will only be realized on accrual basis. So you'd accrue the expenses that you realized already, but you would not be booking any upcoming expected interest payments. Whereas the swap, let's say, would have the fair value of all the upcoming future cash flows measured at present value. So acquiring that swap would increase the volatility within P&L that would not be offset by the underlying hedged item. And this is where hedge accounting comes into play. It's an optional method to modify the basis of recognizing your hedging instruments and or your hedged items. So in our example for interest rate swap, if you have met the standard criteria, the IFRS 9 criteria, you would be qualified for hedge accounting, and you would therefore spare the value of the swap. Instead of it to be being treated as fair value through P&L, it would be fairly valued through your OCI. And hence, the objectives that you're trying to meet is that you'll have a better representation of your risk management activities, and you would reduce the variability within your profit and loss statement. So as we have mentioned, it's an optional method. You can select to apply hedge accounting or not. But once you decide that, no, you want to apply hedge accounting, you want to reduce our variability to our P&L, you would have to qualify with the IFRS 9 criteria. And the qualifying criteria is much more flexible compared to the previous standard, IAS 39. However, there are some boxes to tick before you can apply hedge accounting. So basically, the IFRS 9 qualifying criteria is that the instrument that you have chosen is eligible for hedge accounting. The second is that you will need to meet hedge effectiveness requirements. And the requirements here is that you will need to prove that there is an economic relationship between the hedging instrument and the underlying hedged item, in a sense that the swap that we have entered would contribute to reducing the impact of the underlying hedged item. So there would be an offsetting effect that you can see. Second is the credit risk does not dominate value changes. This may not be a concern when you're dealing with the local banks. We can see that the local banks in the kingdom are of high credit quality. However, when dealing with international banks, make sure that you're not taking a high counterparty risk, because the counterparty risk could impact the value of your financial instruments as per IFRS 13. And then the last requirement within the effectiveness requirements is that designated hedge ratio is consistent with your internal risk management strategy. So what we are entering into is in line with the board-approved risk management strategy or the management-approved hedging strategy. Second is that you will submit to your auditors a formal designation documentation. So you document the risk management strategy, the type of hedging instrument that you're using, the hedged item that you are managing the risk linked to it, and then the nature of risk being hedged. And you would show how effectiveness, hedge accounting effectiveness, will be measured, and how would you treat any ineffectiveness that arises within that relationship. Under IFRS 9, discontinuation is no longer optional. It was optional in the past under IAS 39, where a company can stop hedge accounting at any time. Now, discontinuation only happens when the company or the hedge accounting relationship is no longer meeting the standard requirements. So to boost effectiveness, try as much as you can to match the critical terms of your underlying exposure. So if you're exposed to a loan that is linked to 3-month cyber, try hedging 3-month cyber. If it's Saudi Riyal, then hedge Saudi Riyal. If it's 5 years, hedge, not necessarily 5 years, but match the underlying risk profile. Avoid overhedging. Try not to exceed the underlying hedged item. If you have a 100 million loan, try not to hedge 120 million. And then avoid the use of proxies. This is maybe more relevant or that is seen in practice by PPP projects, where the exposure, the loans are 20 or 30 years plus, and therefore participants or local practitioners, some of them tend to use proxy hedges, so they hedge their real exposure via USD hedging 3-month LIBOR to manage the risk on 3-month LIBOR. We advise against hedging using proxies, as they can break the hedge accounting relationship. And third, be aware of the features embedded in your derivative structure, and we'll explain that in more details in the coming slides. So basically, structures can be plain vanilla, as explained, and sometimes there can be features embedded, cost cheapeners, cost reducers. So the International Accounting Standards Board have said that hedge accounting is for hedgers and is not for speculators. To guarantee that this is the practice, we will not allow any product sellers to apply hedge accounting. So if you are selling any derivative instruments, then you are in the business of making money out of those sales. And they have decided not to allow you the choice of applying hedge accounting. However, a very famous risk management structure is an interest rate collar. So in a collar, you would be buying a cap and selling a floor with an equivalent values, so that you can be participating within a range, and that you have reduced your cost of implementation for that structure. And that is an allowable structure. So then they have introduced what you know as a net written option. So ISP would prefer to make sure that an entity is not a net writer of derivatives. However, it can be a net holder of derivatives. So a combination of options is not always a net written option. A net written option is a structure where your net position, you either be collecting cash for that position, you're a net writer position. So those combinations that are accepted and they're not considered as net written options, you'll make sure that your entity does not receive a net premium. Second, you would make sure that the critical terms of the options, both the sold option and the bought option, are matching in terms of critical terms. You would make sure that that structure is not contradicting with the risk management strategy. So commonly traded non-eligible features, we have seen in the market the practice of entering into a swap with knockout. So let's say instead of entering into a swap at a strike of 3.2, your hedge provider would tell you, okay, you can enter at 2.9, but it would be a swap with knockout. So the strike would be 2.9, the knockout would be 5%. It did achieve your cost reduction structures. However, it may not be aligned with the risk management strategy. So in the case of cyber going above 5%, you would be exposed to the high level of cyber, and that would be against the risk management strategy. Therefore, the IFRS does not allow for similar features to be embedded. The other that is also commonly traded is callability. Sometimes the derivative is offered to you with a callability option that is to reduce the cost of it, in a sense that it can be at the discretion of the bank to call back the structure when it's not moving in their favor. And that is also not allowed under the standard. So that would be the general brief, the high-level brief on the hedge accounting.
Thank you very much, Abdullah, on this value addition. And perhaps now it is the time for us to move to the Q&A session, where we take your questions that you can easily type. And during the past few minutes, I have taken the liberty to see the questions that have been asked. And the theme around those questions is more toward the is the hikes or expectation on interest rate are already priced in? Do we go with IRS? Do we hedge our exposure or not? How the banks are calculating their cyber? So we will tackle one by one, starting from the earlier one. So let's start with the first question. Here we have it. How would a 50 basis points increase in the Fed rate affect cyber? And how, or are the upcoming rate hikes already priced in for cyber? I think this is a very good question. The way I see it is the Fed has been extremely explicit and cautious how to communicate further rate hikes. And we have seen that before our own eyes yesterday in the minute of meeting, the outcome of the minute of meeting of their May meeting. And it has become very much 100% priced in that there are a 50 basis points increase in the upcoming meeting and the meeting after that. So we have at least 3 back-to-back 50 basis point increase in the Fed rate. So we are talking about 2.5 to 2.75 probably end of this year. This is being priced in currently. So when we say, are the upcoming rate hikes already priced in for cyber? Yes. When we looked at the 3-month cyber forward, we have seen that cyber will get closer to 4% in less than 18 months. But beware of one thing. Does that mean that the Fed will actually fulfill these expectations? We don't want to mix the expectations with the actual reality that will happen once they increase another 50 basis points. Everything that is now currently happen is without actually hiking the rate. So if the rate is being hiked, what are the actual reaction from the market? And there is another important element is how cyber would react. Cyber is not only looking at the LIBOR and the Fed rate and even SAMA, when they follow our central bank, when they follow, they increase in tandem with the Fed. But we do also have our own local factor that will impact the cyber as well. The level of liquidity is very much important. We have seen in 2016 where the 3-month cyber was below 1%, and only in a matter of days, it has moved from that level to above 2.3% in a matter of days or weeks. And why that happened? Because of a certain liquidity issue, then things normalized. So we don't want to associate ourselves very much with what's happening on the Fed, but because it's a mixed bag of variables that we see. So yes, currently the 50 basis point, the couple of 50 basis point hikes now is currently priced in the cyber, and that pricing in kind of situation is changing every day depending on what the market has to say. Okay, we do have another question here. Do you recommend hedging now against our loan portfolio, or what is the percentage you recommend and why? Perhaps the most important question here is why. Why are we hedging? You will be surprised that some firms, even when we talk to them, that they needed to hedge 0%. 0%. Why? Because they have, for example, natural hedging. When we look at the firm holistically, we find that, for example, a treasury department or a department within the company has a certain borrowing, but other department has an offsetting exposure. So again, you look inside the house, you look first of all to identify the risk. Then after identification, we see how the risk would impact us and impact our KPI. So if your KPI can withstand and can accommodate such movement, and there is a clear risk appetite, then you might not hedge as much as you think you wanted to hedge. You might go for a 20 or 30% instead of 90 or 100%. Hedging 50%, it is the most basic decision that we can easily challenge. That percentage has to come uniquely from that firm, and why they are hedging, because they have a certain line items that they want to protect. So if I am a financing company and I aim to manage our asset and liability management book and decrease the mismatch, then this becomes a necessity for me, because this mismatch could be fatal in this environment where interest rate unprecedentedly goes on the high side. Okay, we have another question here. Hi, Muad. Do you think the IRS rate is still good to enter into hedging transaction? صراحة, some firms would say that the IRS is already expensive. We are at 3.5, 3.6% to hedge our exposure. And that rate, by the way, was around 4% only a couple of days back. And you might think that it's already priced in. Why would I do that? Why do I hedge? And again, the market does not only have an IRS, it has another instrument like a cap, for example, where you pay a premium and you enjoy the market if it does not go higher, but if it goes higher, you are protected. But again, you pay a premium. However, it's difficult for you to say that, to look at the historical swap movement or cyber movement, and you say it's priced in, because what we have observed and what we have demonstrated in this presentation, we saw 5 themes on the Fed and in the market only from 2018. So it's good to be protected. Financial risk management is around having more visibility around what comes next on the item that you can control, not to take advantage or take a profit of these hedges or what you do from a financial risk management perspective. Okay, we have here a question, Salam, on which basis bank build their interest rate for loans and customer deposit, knowing there are repos, reverse repos, LIBOR, cyber. Okay, now what we used to have in terms of calculating the cyber from the local banks, it is for the cyber banks to basically it was based on an expert judgment, where every morning every bank puts their quote in what they expect that the cost of funding of loans among these local banks, Saudi Arabian interbank offered rate, the cyber rate, and based on that they put the cyber and they carry on. Now, effective 2022, that has changed significantly. Now, the cyber rates are not based on purely expert judgment. They are based on actual, genuine, qualified transactions. So this transaction comes from the deposit that they accept. And from that number, they build on and they publish their cyber numbers. And the observers of the cyber movement recently, they have seen volatility on the cyber that we have not witnessed previously. Why the volatility? Because the cyber is really based on these actual transaction and not on the expert judgment. And of course, that cost of funding is impacted by many factors, such as the liquidity in the market. How come some banks give lower interest rate on loans than on deposit? Okay, what I can say here is 2 things. Asset and liability management is an art. It is really an art. So if the bank can manage their asset and liability in a way that it can acquire more client, it can approach a wider audience because they have managed to have a robust asset and liability management, then they can do that depending on how they manage to do that. And of course, sometimes it is not purely commercial from their perspective. So it really depends, even in terms of the type of the deposit and the type of loan that they offer. Okay, what is the maximum cyber in the past? Do you see that KSA regulatory authorities absorb the maximum hike and put up a cap? Okay, now the maximum cyber in the past, we have seen it just before the financial crisis. We have seen it at, as you know, 5%, 6%. It went there, then it collapsed to close to 0% during the expansionary period and the quantitative easing period. Now, when it comes to the regulator and how they absorb the hike, the regulator has a clear mandate, which is protecting the pig. And what we can say that maybe we are blessed because we are in an economy where there are a recession looming and the Fed is increasing the rate. However, the prices of oil is on the high side, so it protects or it creates that balance. Imagine a situation when everything is the same. However, the energy prices at all-time low at $20 or $30 in the oil. So it become a very difficult. And of course, the regulator has no option but to go parallelly with the Fed. Otherwise, the peg will be threatened by speculations, and it will be very much challenging to defend the peg. So it will be very much challenging for them to put a cap. Maybe there are various aspects. They lower the impact by doing a bit of open market operations where they manage the liquidity, where they inject or take out liquidity from the market. Okay, maybe this is a question for Abdullah here. Abdullah, there is a question that you can see. What about the transition of LIBOR to SOFR? Will it affect the hedging transaction process in terms of rate? So this question is around the transition from LIBOR to SOFR. Please go ahead.
Thank you, Mu'adh. Basically, yes, it would have, let's say, on the hedge transition and on the loan as well. From an accounting perspective, as you may be aware already, there are varieties of SOFR calculation methods. So there is the SOFR in areas, there is the term structure. There are futures that have developed a future market for SOFR transactions, which are commonly used for hedging transactions. So basically, avoid selecting a SOFR basis that is different between the loan and the hedging instrument to make sure that your hedging strategy is effective. This is first. We had a webinar discussed in more details around the LIBOR transition and its local implications. There are different variety of considerations that are to be taken for companies that are transitioning or planning to transition in the future. So there is a documentation part where in the fallback language you need to make sure that you have decent control over the process. It isn't purely on the hand of your counterparty, your hedge provider or your loan provider, to make sure that your objectives are met, your loan hedged item and hedging instrument are aligned in terms of features and underlying interest rate exposure.
Thank you, Abdullah. And of course, similar to this question, there is another question says, would the shift from LIBOR to SOFR have a counter effect to SAIBOR by decreasing it? Will SAIBOR be actually decreased because SOFR is lower?
Okay, so the basis for SOFR are different. SAIBOR should not be impacted heavily. Basically, SOFR is based on actual transactions, and there is no expert judgment. So you could be taking out that SOFR in itself, that underlying transaction, does not account fully for the creditworthiness of the financial institutions. So SAIBOR is based on the actual transactions, and then there's an expert judgment to top up that actual transaction rate with the credit quality of the counterparty that it's dealing with. So SOFR does not have that credit quality, given that it is secured overnight financing rate. So it is more, it is higher in credit quality. So SAIBOR is different in that sense. However, the SAIBOR itself would be moving to that SOFR, and then those adjustments will happen to take place. So SAIBOR could be impacted when transitioned to alternative reference rate. However, that difference in credit quality could be added on top of your credit margins. So if you're dealing today with a credit margin of 1%, you could expect to have a higher credit margin to account for that piece that is taken out between SAIBOR and SOFR.
Great, thank you very much. And perhaps the last question here I would take is, entering into SAIBOR hedging is better for the time being than LIBOR because of the transition. Okay, this is a statement that I completely agree with, but I will add another reason for that. If we have a SAIBOR exposure, then regardless of the LIBOR transition and its true complications, I would still go for SAIBOR, and I will have that very much highly correlated or identical critical term match between SAIBOR and LIBOR. I mean, hedging LIBOR exposure or hedging SAIBOR exposure by a LIBOR-based derivative, even if there is no transition, it is very tricky. It is very dangerous because of the correlations sometimes do tend to break. like we have seen in 2016. So I guess I'm afraid that the time is up for the webinar. We will share the recording with you later. For more resources, you can check our website, ihata.com.sa, where you can see all the articles, also this webinar. We will share it also. If you like to follow up on any question, or in case that there are any unanswered question, please do get in touch and we'll be glad to get back to you. As I said, we will email you the recording of the webinar, so please feel free to share it or tag it. Finally, sincere thanks to you for joining us. We look forward to conducting similar webinars going forward. Thank you and goodbye.
Thank you, everyone.